up, guys? It's Cash Flow Cart, dude. We are back recording another video. I'm very, very excited today. We are doing a Coke versus Pepsi comparison. Hopefully, this can be an educational one. I have done a video similar to this before, okay, 1 year ago. Coke or Pepsi stock. That video performed super poorly. Oh well. I remember at the time I thought it was like a good video and then it just got no views. That's kind of how life goes sometimes though. Um, Hopefully my content has gotten a lot better in the past year. I certainly think it has. The thumbnails look a lot better. The portfolio is worth a lot more and life is good. So we are going to kind of recreate that Coke versus Pepsi video. First off, we'll start with a quick life update, guys. If you do not know, I am in the restaurant game. So, hospitality this time of year, it's a little slower. I have had a lot more time dedicated to due diligence. There's not as many shifts in hospitality right now. And it's definitely just a lot slower, and that has left me more time to focus on investing. But with that being said, it's also left me less money to focus on investing. Definitely not as many fun videos like we had, in the fall. Let's see, for example, July. Or like investing $500, investing $1,000. Not as many like cool, flashy videos because I don't necessarily have that buying power right now. But that is okay, guys. Today we are going to invest $300 in Pepsi stock. Let's go ahead and do that, and then we will get into the video. 300 in Pepsi is going to be, roughly 2 shares. So that brings my Pepsi position to 23 shares long at an average price of $144.78. So as you can see, I'm pretty much exactly break even on the Pepsi position right now, guys. This is a newer one for me. Okay, enough yapping. Let's get into it, guys. The first thing we are going to do in this video is compare the valuation on these two guys. Interestingly enough, on Seeking Alpha now, it has a button that says Analyze with AI, which I think is, pretty ridiculous. Me personally, I'm pretty tired of everything, being tied back to AI, but that's just me. I think buying a single blue chip stock is not nearly complicated enough to need AI to help with your decisions. But maybe that's just how I feel. Let me know what you guys think. So for valuation, guys, we'll pull up Coke, we'll pull up Pepsi, and we will kind of observe the differences, guys. As always, I like to use the price to cash flow on a forward basis. Okay. As a dividend growth investor, this is the valuation metric I like to use in order to determine if a stock is undervalued or overvalued. Okay, Coke's right now is 29.64. Okay, Pepsi's is 14.02. Okay, and the way I'm comparing these is not going to be comparing, one metric to another, but it's going to be comparing, each metric back to that company's 5-year average. We talk about this a lot, but I think it's one of the most important concepts to grasp for my specific style of investing. Okay, I understand that every different company, especially kind of the blue chip value guys I'm oftentimes interested in, they're going to trade at kind of a different valuation or premium for that company. Okay, so I don't think it's fair then for me to compare a premium guy like Coke back onto its peers in that space, or even comparing Coke to Pepsi. Does that make sense? So I always focus on comparing current data back onto that company's trailing average. Okay. Again, I talk about that a lot. So Coke's current price to cash flow is 29.64. Their 5-year average, okay, is 23.66. Without crunching any numbers, without doing any, complicated stuff there, we can say with reasonable certainty that Coke is overvalued compared to, where it's historically traded at over the course of the past 5 years. How overvalued using this metric? 25.25%. Okay? So Coke is trading 25% higher than it does historically using this data point, price to cash flow. Okay? We'll look at Pepsi. Price to cash flow currently 14.02. Okay, their 5-year 19.03. Okay, it doesn't take a mathematician to tell you 14 is less than 19, and we can say with reasonable certainty Pepsi is undervalued compared to its 5-year track record. By how much? Roughly 26%. Okay, so I'm gonna have to hand the valuation the valuation part of this video, Pepsi is the winner. We can see, using my favorite valuation metric, Coke is 25% overvalued, Pepsi is 25% undervalued. Okay, does that make sense, guys? The next category we're going to be comparing these two on is going to be diversification, okay? The brands, the different products that each parent company owns and offers. Guys, let's get into it. Again, this is something I have talked about before, but I kind of want to revisit this idea of single stock diversification. Okay, so as you know, within my style of investing, I'm very opportunistic. Adding positions is typically a little more slow moving because I'm more focused on building out, what I see as the best opportunity at any given time. With that being said, a lot of my diversification within my portfolio comes from diversification within single stocks. Okay, so Pepsi, for example, they own Aquafina as well as, Doritos. Does that make sense? That's diversification all under, Pepsi. Okay, ticker PEP. So which stock, Coke or Pepsi, has the better single stock diversification? We are going to give it to Pepsi, but let's just take a look at why. Guys, with Coke, you only really have beverages, okay? So Coke is strictly a beverage company, while PepsiCo is actually a snack and beverage company, okay? We get a little better diversification in that sense. I have to hand it to Pepsi. While Coke does have a very impressive portfolio, Fairlife, Fanta, there's recent stuff with alcohol brands, Peace Tea, Powerade, all this, Smart Water, Topo Chico, Vitamin Water. Pepsi just offers more diversification, and for that reason, I have to give the diversification award to Pepsi, okay? Now, do we kind of understand this concept of single stock diversification? I would say Pepsi is one of the best, in my opinion, in terms of dividend stocks that allow access to the most diversification. Another one I think is very interesting would be Procter and Gamble. Another very diversified stock, kind of in the consumer staples space. We'll just take a peek at P&G, diapers, fabric care, these are huge names, right? Like Tide, family care, feminine care, grooming, hair care, home care. Pretty much you can recognize all of these, household names here, guys. This is just another example of a stock with, amazing single stock diversification, multi-brand programs. Not 100% sure what this is. oral care, healthcare. I mean, this is, this would be one that, in my opinion, would rival Pepsi, but in a little different space. Okay, so moving on, guys. I'd say a couple other honorable mentions kind of in the single stock diversification contest would be Kimberly-Clark. I think another good one would be 3M. Okay, I can't lie to you guys. I kind of got scared out of 3M. I was a shareholder. Maybe exited that one before the YouTube days, but I did kind of get scared out of that one when they had the whole, combat earplugs fiasco and, lawsuits were piling up. But it was a good learning lesson for me. I learned about my personal risk tolerance as an investor. So, I guess it was an expensive lesson, but it was still a lesson. Next up, guys, we are going to talk about technicals, Coke versus Pepsi. I don't want to become, what am I saying? I'm not necessarily a technical trader, okay? And that's not my niche or style on YouTube so much. But I will say I like to use, very basic, I guess, obvious technical indicators that have helped me. I've worked with a lot of different things, and I kind of always come back to just the basics, okay? And for me, it's going to be basic chart patterns as well as the 200-week moving average, okay? This green line here is the 200-week moving average. As you can see, I typically like to buy into stocks that have, broken below it to a healthy degree. So we see Hershey, for example. Yeah, so what I was saying is I'm typically going to be interested in picking up stocks when they have a healthy margin, back up towards their 200-day moving average. Okay, so for example, right now, if Hershey were to make a move back to its 200-week moving average, that's a 29% positive move. Okay, we've seen some trims on Apple and Microsoft, both of which seem to be pretty overextended from that 200-week. Okay, again, like I said, I've studied a lot of different technical analysis stuff. However, as a dividend growth investor, I don't typically bring too much of those indicators or anything else to this game besides the 200-week and, basic chart patterns. We're talking like all-time high breakouts, channels, flags, descending wedges. Same thing with Microsoft, okay? I've trimmed it recently. It is, over 30% extended from its 200-week, okay? Pepsi, let's visit it. A move back to the 200-week on Pepsi would be almost a 20% up move, whereas Coke, it's extended from it. Okay? So Coke's about 10, 12% higher than the 200-week. Okay? So technicals, I got to give that to Pepsi. Okay, guys? Last but not least, we are going to visit, kind of some dividend metrics, and I'm going to kind of give my take on some different metrics here. Okay, starting off with the dividend summary, guys. The current dividend yield on Coke is 3.01%, while Pepsi's current dividend yield is 3.75%. Okay, current dividend yield, we got to give that to Pepsi. The dividend growth streak, Coke's is 62 years, Pepsi's is 52 years. Okay, we have to give that to Coke. However, for the sake of things, I don't think there's much of a difference between a 52-year growth streak and a 62-year growth streak. I think both have kind of more than demonstrated their commitment to keeping this dividend growth streak alive, guys. Both very reliable type of plays. The 5-year growth rate, Pepsi, again, we got to give it to Pepsi at over 7%, while Coke's is just under 4%. Okay, something I commonly preach on this channel is that this 5-year growth rate is no guarantee of future growth. However, it does show kind of, I guess, the recent moves the company is making to reward shareholders. Just to look a little deeper at this growth rate, the 3-year compound annual growth of Pepsi's dividend is 7.86%. That is higher than their 5-year CAGR. Okay, the story that tells me is, at least in the past 3 years as compared to the past 5, Pepsi has accelerated, the growth rate of that dividend. Okay, Coke's tells a similar story, however, with slightly less impressive numbers. Guys, this is a super important metric to look into. Obviously, the quicker a company grows their dividend in unison with that starting yield you can lock in is going to really lead you to that outperformance we look for as dividend growth investors. Okay, does that make sense? One other thing I want to look at here is dividend safety. I think these are pretty comparable. So keep in mind, guys, both Coke and Pepsi are very mature companies. And with that, there's going to be less kind of growth prospects in their core businesses. And a higher percentage of their free cash flow is going to go towards rewarding shareholders in the form of dividends, guys. If we're looking at something like Apple or Microsoft, we can't use the same lens as looking at something like Coke or Pepsi, okay? That just doesn't make sense, okay? Apple and Microsoft, they need more free cash flow to reinvest into the business as they're still, more growth-oriented than something like these two guys, okay? Does that make sense? So, again, we're going to look at the cash flow payout ratio on a forward basis, okay? For both, Coke's is at 88.99%, while their 5-year average is just under 73%, okay? So currently Coke's, cash flow payout ratio is a little higher than I'd like to see. Again, I'm coming to this conclusion by kind of comparing it back onto itself, as well as just intuitively realizing that, that high, almost 90% of cash flow going to dividends is not necessarily the most sustainable thing, okay? Obviously, this is something Coke will have to get under control. Let's look at Pepsi's, guys, a little more attractive at 54.37%, right in line with their 5-year average. Okay, so dividend safety, I've got to give to Pepsi again. Okay, does that make sense? Just to review, guys, in today's comparison, we visited a few different metrics from Coke and Pepsi. We looked at valuation, and we determined that Pepsi is currently a better deal right now. We looked at diversification, and we determined that Pepsi has more single stock diversification and is more attractive in that sense. We looked at technicals, and we determined using the 200-week moving average that Pepsi is more attractive from a charting standpoint. We looked at the dividend scorecard, and we determined that Pepsi's current dividend yield as well as their future growth prospects are more attractive than Coke's. And we looked at dividend safety, and we determined that Pepsi's dividend is currently safer than Coke's. Guys, with that being said, this is kind of why I am very much focused on adding this one throughout the rest of the year. Currently, I have 23 shares at $3,335 market value. This is one I would like to move up the ranks as 2025 continues. We will see, just how high it climbs in my portfolio. Guys, as always, thanks for tuning in. This is Cash Flow Cart, and everybody have a great rest of your week. Let's build wealth.